In these last few sessions, we've laid out the 4 ingredients that drive the value of a business. The cash flows you get from existing assets, the expected growth in those cash flows, the risk in those cash flows as captured in a discount rate, and the point in time in the future where you apply closure on those cash flows, the big terminal value number. In this session, I hope to build on that concept. In particular, I want to talk about how to change the value of a business, hopefully, how to enhance the value of a business. Note that I said value enhancement, not price enhancement. Two very different concepts. In value enhancement, everything you do has to flow through one of the 4 ingredients. You either have to find a way to increase cash flows from existing assets, or you have to push up the growth rate that you see in the future, or you have to reduce the risk and the discount rate you apply to those cash flows, or you have to push off the day of closure where your company becomes a stable, going concern, or you liquidate the business. Everything you see in restructuring and value enhancement has to go through one of those 4 pathways. And in this session, I hope to lay out those pathways. Now that we have all the ingredients to value a company, the cash flows, the growth rates, the discount rates, and the closure factor, the terminal value, we can value any company, right? I want to talk a little bit now about how to change the value of a company. Because if you run a company, the question you're often faced with is, how do I increase the value of the company, not just maintain the value? So I want to talk about value enhancement. Before I get started though, I also have to note that when many companies talk about value enhancement, what they're talking instead about is price enhancement. And that's a very different thing. To illustrate the difference, I'd like to show you 2 graphs. These 2 graphs both look at companies that changed their names. They're separated by about 4 years. The first study happened in the late 90s, and it looked at companies that added .com to their names. Remember, this was the peak of the .com boom. And not surprisingly, when they looked at these companies that added .com to their names and changed nothing about their businesses, they saw the prices jump by a lot, 100%, 150%. Now remember, if they're not changing anything about their businesses, their intrinsic value shouldn't have changed. But their price did jump. You're saying, this is good. Why waste your time on cash flows and growth rates and discount rates when all you have to do is change your name? But what the market gives, it takes away. The second study also looked at companies that changed their names, but this was in 2002 after the .com bust. And these companies removed .com from their names. The market reacted positively. What I'm trying to say is, if you try to make your job increasing prices or enhancing prices, you're going to be dancing to a tune that the market calls, and that tune might not be the best one for your company. So rather than focus on things you can do to increase prices, I'd like to talk about how to enhance value. And here are the 4 ways you can increase value, and they go back to the 4 pillars that we used to talk about valuation. To increase the value of a company, you can try to increase the cash flows from existing assets. Run them more efficiently. To increase value, you can try to increase your growth rate or enhance the value you get from growth, either by becoming more efficient about running your existing assets, or maybe finding a better combination of reinvestment to deliver more value from your growth. The reason I say more value from your growth rather than higher growth is some companies might actually be worth more growing at a lower rate rather than a higher rate if their growth is not good, if it's destroying value. Third, you can try to lower your discount rate. The obvious way might be to change the mix of debt and equity, but there might be others. And the fourth and final way is you might put off that day of reckoning when you become a mature company, a stable company. How are you going to do this? If you can build up your competitive advantages and barriers to entry, maybe you will not become a stable growth company for 10 years rather than 5. So increase your cash flows, try to get more value from growth, lower your cost of capital, push off the day of reckoning. So I'm going to talk about how to change value using those 4 basic approaches. Let's start with the first one. How to increase cash flows from existing assets. Let me break down how we measure cash flows. We start with operating income, we net out taxes, then we net out reinvestment, right? If that is the case, here are the places you can go to increase your cash flows from existing assets. You can run your assets more efficiently. You can cut costs that are really not creating any value. What I hear when you say that is higher margins, higher operating income on the same revenues. That's going to increase your value. If you can pay less in taxes on that operating income, and I don't mean to sound unpatriotic when I do this, but I don't think any company should view it as its objective to maximize taxes paid. So to the degree that the law allows you, if you can minimize taxes paid, you pay less taxes on the same operating income, you increase your cash flows, and you increase value. And if you can reinvest less to maintain your existing assets, you can increase value. So basically, you're looking for places in your existing cash flow where you can get more cash flows and higher value. If you're coming into a firm which is an old, mature firm, this might be the place to look for higher value. Is can you cut costs? Can you increase cash flows from existing assets? Second stop on the road, look at your growth rate. As we've structured growth, to grow faster, you either have to reinvest more or reinvest better. Reinvesting more will tend to increase your growth rate almost always, but reinvesting more might not always increase your value. Because here's the qualifier. Reinvesting more creates value only if the return on capital you earn is higher than the cost of capital. So let's step back. Here are the two ways you can reinvest more. You can try to find more projects internally, but that's going to take you a long time, or you can do a big acquisition. You can always buy growth, but if you pay too much for that growth, it's not going to increase your value as a company. You can try to improve your return on capital in existing investments, and I like to think of return on capital as broken down into two components. There's your operating margin, and the second is how efficiently you deploy your capital, your sales to capital ratio. So if you can increase how much revenues you get for every dollar of capital you've invested or improve your margins, it shows up as a higher return on capital. I would argue that almost everything we talk about in business, even if it's pure marketing, will show up in one of these numbers and will ultimately show up in value. Now, when we talk about growth, we tend to think of different ways companies can grow, and we often make the mistake of treating them all as equivalent. But there's some very interesting research that's emerged over time that looks at which growth approaches are most likely to create value and which ones are most likely to fall short. This is from a McKinsey study that I saw a few years ago, which looked at companies that had adopted different growth strategies over time and then asked a follow-up question. How much value was created by each growth strategy? Ranked from best to worst. By far the best strategy McKinsey found across companies was a strategy of coming up with new products. Think of Apple in the last decade. The iPod, the iPhone, the iPad created tremendous amounts of value, new products that break through into new markets. Why doesn't every company try it? They do, but only a few succeed. And if you do succeed, there's no better strategy. The second best strategy is to find new markets geographically, or new markets within the same geography to do different things. Aspirin, headache medicine, right? Until it became something that could be used to treat heart disease. So expanding into new markets, expanding a market, second best strategy. Fighting for a market share in a growing market, not a bad strategy, because even if your market share stays constant, if the market itself is growing, you can still be profitable. And then you get to the two strategies that historically have been more likely to be losers than winners. If you fight for market share in a stable market, the only way to get a higher market share is often by cutting prices. It might not be value enhancing. You might get more growth, but the lower margins that growth comes with will deliver lower value. The worst strategy of all historically has been a strategy of growing through acquisitions. I don't mean to be cynical, but if you grow by acquiring other companies, especially if they're large publicly traded companies, the only way you can win is by paying a premium over the market price. That ups the ante. It's much more difficult to win with an acquisition-driven strategy. I'm not saying it's impossible, but it's much more difficult. So when you think of growth strategies for a company, look for the one that is not just likely to deliver the most growth, but the one that's also likely to deliver the most value. The two might not always be the same. Which brings me to the third way in which you can increase value. Maybe you can push for a longer growth period. The abstraction, that's a number that you use in valuation, but it reflects your competitive advantages. So what I'm talking about here is either coming up with new competitive advantages if you don't have any, or if you do have a competitive advantage, sustaining and augmenting that competitive advantage. I'm not a corporate strategist, but I can think of at least 4 potential competitive advantages that you could be building on. The first is a brand name. There's no better competitive advantage in history because nobody quite knows how you create a great brand name. But if you have one, take care of it. It might account for 60, 70, 80% of your value, and it's a very difficult competitive advantage to overcome. The second is legal barriers to entry. If you're a pharmaceutical company and you have a patent, you're protected from competition. So look towards some degree of competition. Perhaps your lawyers can help you. If the government offers you protection from competition, be careful, because there's always a quid pro quo. In return for that protection against competition, you might have to give up pricing power. But if you can get protection against competition, go for it. The third is switching costs. What am I talking about? You want to make the cost of switching into your product as low as possible, and you want to make the cost of switching out as high as possible. If you can do that, you've created a significant competitive advantage. And the fourth and final potential competitive advantage is if you have a cost advantage over your competition. It costs you less to produce a product. You can build on that, right? Either by charging a lower price than everybody else and selling more, or charging the same price as everybody else and delivering a higher margin. So when I hear strategists talk, that's basically what I'm looking for. Are there things this company can do that can push out their growth period and increase their value? So that brings me to the fourth and final way you can increase your value, which is to reduce your cost of capital. When you talk about it, the most obvious measure that people use to reduce the cost of capital is to change the mix of debt and equity. And that works. If you're a company that's 95% equity, maybe by going to 75% equity, 25% debt, you could have a lower cost of capital. The reason, of course, lies in the tax code that seems to be tilted towards debt. But there are other ways you can lower your cost of capital. And here are the three other ways. One is you can try to make your product or service less discretionary to your customers. In other words, make it more of a necessity. I don't know how you're going to pull that off, but if you can, that reduces your cost of capital. The second is you have a lot of fixed costs as a company. Try to bring them down. Fixed costs make you a more risky business. They increase your cost of capital. I can think of at least two ways you can bring your fixed costs down. One is outsourcing, where you take a fixed cost and make it a variable cost. The other is you try to form more flexible wage contracts with your employees. That again makes your cost structure more flexible and it lowers your cost of capital. There's one final thing you can try. If you mismatched your debt to your assets, you've used short-term debt to fund long-term assets, dollar debt to fund euro assets, get rid of that mismatch. It increases your default risk and increases your cost of capital, and getting rid of the mismatch will lower your cost of capital. So here's what I do. If you gave me a company and said, how would I increase the value in this company? I'd have to take a look at the company. I'd have to look at the places I'd go to try to increase value. So let me try one simple example. This is a valuation of SAP I did a long time ago. Value that I got per share was 106 euros. But if you look at the top of the page, it says SAP Status Quo. So what does that mean? I valued SAP with its existing management in place. The existing management in 2005 was a pretty good management, but there are two blind spots. One is they hated borrowing money, and that shows up in their debt ratio. It's 1% debt, 99% equity. The second was they were a little wary about investing in emerging markets. So even though their reinvestment rate is healthy, 57%, it's not that high given their opportunities in emerging markets. So this value reflects the company as is, run as is. So let's assume that you came in. You're the new CEO of SAP. What could you do differently? Well, the first thing you could try is try for more debt, right? But you can't just increase the debt ratio to some number without knowing what consequences it'll have. So to help you in that process, here's what I've tried. I have actually estimated the cost of capital for SAP at different debt ratios, from 0% all the way up to 90%. It sounds fancy, but here's all I do. As the debt ratio goes up, I re-estimate your cost of equity. And not surprisingly, as you borrow more money, your equity gets riskier, your cost of equity goes up. As you borrow more money, I also estimate how much it will cost you to borrow money. That'll go up as well. But the weighted average of those two numbers actually goes down, at least initially. In fact, as the debt ratio goes from 0% to 10 to 20, all the way up to 30, notice the cost of capital keeps dropping. Beyond 30%, that starts to hurt you. Your cost of capital goes up. If you ask me what the optimal mix of debt and equity is for SAP, I'd say 30%. So here are the two changes I made at SAP and revalued them. I increased the debt ratio, saying they should be a little more aggressive about borrowing money. That lowers their cost of capital. I also assumed a higher reinvestment rate, that they could reinvest more in emerging markets, and that pushes up their growth. It's magic. With those two changes put in, the value per share that I get is 126 euros. Obviously, this is a lot easier to do on a spreadsheet than in practice. But with real businesses, that is often the challenge you face. How do you change the value of the company? How do you make those changes on the ground? And how do those numbers ultimately show up in your value and price? Summing up then, if you have to enhance value, start with the basics. And the basics ultimately are, to change value, you've got to increase cash flows, you have to find a way to get more value from growth, to reduce your cost of capital, or you have to push out that stable growth period. They're all doable. None of them is easy, but enhancing value doesn't happen in a corporate finance boardroom. It happens on the shop floor. It happens in the marketing department. Value enhancement is everybody's responsibility.